Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. The net percentage of domestic banks that are tightening their standards for lending has been rising dramatically throughout 2022, and more recently we got a reading for the first quarter of 2023 that sits at the highest level we've seen since COVID, before that 2008, before that 2002. The entire economy, the entire financial system revolves around credit. It revolves around the idea that banks lend to businesses, banks lend to people so that they can go out and spend. That creates what you call the boom and bust cycle. Credit booms occur when credit is easy to get, and credit contractions occur when the banking system is tightening their standards. That's what happened in the last two bear markets in 2001 and 2008. So we're going to take a look at that in detail in this video, and this is going to tell us whether we should actually be convinced by the rally that we're currently seeing on the stock market right now, or whether we're actually at the very beginning stages of a credit contraction cycle like 2008 and 2000. So what we're essentially answering in this video is the big question, whether or not we are actually going to get a hard landing or a soft landing. So we're actually answering the big question by looking at this data set in this video, whether or not this tightening cycle that we've had from the Federal Reserve that's been hiking rates very aggressively over the past year, whether that's going to lead to a soft landing or a hard landing. Don't forget to smash the like button if you enjoyed this video. And of course, if you are new here, don't forget to subscribe to the channel. Now, without further ado, let's get right into it. So our entire financial system revolves around credit. If credit is plentiful, right, domestic banks are lending a lot of money, tightening standards are very low, that can create a credit boom. Businesses can take on loans, people can take on loans, they can go out and spend more, buy more stuff, and so the economy grows. On the other hand, when credit is hard to get, like here in 2001, well, you get the very opposite cycle. Businesses don't have access to credit, people don't have access to credit, they cut their spending or they even lose their jobs as businesses are cutting their spending, and you can easily enter a period of economic contraction where, of course, you're going to see the stock market go down. Now, let's put this chart here against the federal funds rate. So let's add the Fed funds rate right here. That is basically the interest rate that the central bank, the Federal Reserve, sets, the rate at which it lends money to other banks. The central bank lends money out to domestic banks, and domestic banks lend out money to people and businesses. So the central bank has a direct impact on what domestic banks do. Now, it doesn't control everything they do, and we're going to talk about that in just a second, but they do have a direct influence on how much these domestic banks are willing to lend out money. More recently here, the federal funds rate has risen, so the central bank has tightened its monetary policy, and you can see the domestic banks have also tightened their monetary policy as a result. Now you can see that usually actually happens that way, right? As the Fed funds rate lowers its interest rates while domestic banks also lower their lending standards. As the Fed funds rate rises, you can see here, well, tightening standards go up. However, you can see there are some key periods like here in 2007, 2008, like here during COVID. Tightening standards are very elevated despite the fact that the central bank is actually easing money. Even in 2000, 2001 here, you can see domestic banks were still keeping their standards very tight here until around, let's say, December of 2001, despite the fact that the federal funds rate had gone from around 6.5% all the way to 1.6% very rapidly right here. Domestic banks still were not looking to lend money in this environment. So what was going on here in both 2001 and 2008? Well, let's remove the federal funds rate and add this chart here of delinquency rates on consumer loans. If we put both of these together, you can see that they also have a very strong correlation. And it puts a little bit more context behind why these domestic banks back in 2001 and back in 2008 were not willing to lend money because delinquencies were very high, right? Think about it. If you're a bank, you're a business, you want to make a profit, are you really going to go out and lend out a lot of money when you're in an economic environment where people are not repaying their loans, where delinquency rates are rising? Probably not. And that's exactly what happened in 2001 and 2009. And by the way, in both of these bear markets, the stock market didn't bottom until after domestic banks started to ease their lending standards again. You can see here in 2002, the market bottomed several months after the peak in tightening standards. And in 2009, same thing, several months after the peak in tightening standards, right here in blue. So now the question is, should we expect this to start going down? So it's nice to look at history, but what's going to happen now? What's going to happen now? What I want to show you here is I actually want to shift the tightening standards forward by a few quarters right here. And we're going to delete the previous line so the chart is cleaner. And you can see here now that we've shifted forward the tightening standards of domestic banks by a couple of quarters, well, we can see that it perfectly coincides with the tops and bottoms in delinquency rates, which means domestic bank tightening standards are basically leading indicators of delinquency rates, leading indicators of the macro environment. So what this chart is actually telling us is that delinquency rates are going to continue rising over the next couple of quarters and that the macro environment is only going to get worse. So you're probably wondering, that doesn't make sense. If domestic banks are tightening their standards because delinquencies are rising and delinquencies rise because banks don't lend, that's basically a never-ending vicious cycle. And you would be completely right. That's why recessions are very rarely just little bumps in the unemployment rate, and why systematically you get massive amounts of layoffs during recessions. You don't just get a small economic contraction, you get what's called a hard landing. And once domestic banks start tightening, the odds of getting a hard landing increase substantially. And that's why none of the soft landings are actually very obvious on this chart. 1994, right here, that was a moment where the Federal Reserve was tightening very aggressively. Again, I can put the federal funds rate on top of this chart, and you can see the federal funds rate was rising very, very aggressively here. And yet domestic banks were not really tightening monetary policy. Lending standards were still very easy throughout this period. You can argue the same thing was happening here in 2018 as the Federal Reserve was tightening money. Well, lending standards were staying relatively low, right? They weren't rising yet. It wasn't until COVID happened that, yes, okay, lending standards got very tight as banks were very concerned about the future of the economy. So both of these soft landing scenarios, you can argue that 1994 and 2018 were soft landings. In both of them, domestic banks were not tightening their lending standards. Today, they are. Right? By the way, if you're so far enjoying this episode, don't forget to click on the like button. It helps us out massively. If you're getting some answers, getting some value out of this video, and you're finding it helpful, make sure to show your support to the channel. So how does the vicious cycle of recessions actually end, right? Because if it doesn't end, then you just go into a depression like 1929. And it's very simple. The vicious cycle ends when the federal funds rate has eased money enough. Delinquencies are still very high, so it's a risky environment. But on the other hand, the Fed is giving us money at a very, very cheap rate. So we're getting a lot of reward to go out and lend money, even though the environment is very risky. That's why the central bank is very powerful, but it doesn't force how much domestic banks were actually lending money. That's why in 2008, the central bank had to actually bring rates down to zero in order for domestic banks to then start saying, okay, this is worth starting to give out credit again. And the zero rate policy that we saw in 2009 was why we didn't go into a depression. Now, whether you are for or against that zero rate policy we had between 2009 and 2015, the Fed probably didn't have much of a choice here. So what does that mean for today? It means that we're still in the part where delinquencies are rising as a result of banks tightening their lending standards. We're also in the part where the federal funds rate is still hiking rates and is still quite far off from cutting rates. Now, we do think that a pause is likely to occur very soon, and that's why the market is rallying right now, why there's a lot of momentum behind this move right now, because the market is pricing in the fact that we are getting closer to a pause. And even in 2006, right before one of the worst financial crises in history, the Fed pause triggered a significant rally in the market before the ultimate top. But these tight lending standards are eventually going to start to create a recession. We've talked about this a lot over the past couple of months. Earnings, we're getting closer to that point where earnings, S&P 500 earnings, are likely to decline as a result of this tight monetary policy, the fact that we are heading into a hard landing, and that things are likely to get worse before they get better. Of course, that is just my opinion. I love to give my opinion out. It's an immense privilege. I'm very thankful for it to be able to do this and to have you guys listen to my perspective on the market. So take it for what it is. We have been raising some cash on the model portfolio at gameoftrades.net. We closed some of our more successful trades, German small caps and copper miners, that we had throughout the second half of 2022. EWGS outperformed the S&P by 23 percentage points since its inclusion in the model portfolio. So obviously those kind of gains are very sweet and add to the outperformance of our model portfolio, but nothing goes up in a straight line. So we locked in some profits on those trades and added to a little bit of cash so that we do increase our defensiveness on this rally. Right? The market is very, very strong here. Now, we don't want to fight the momentum. We're not going short here. We're keeping a lot of our US bets. We still have quite a bit of our US equity exposure right now, but raising some cash on this rally is making us much more likely to outperform the market if we were to have another leg down. Of course, if you want to follow our updates every step of the way on our website, don't forget to grab a free trial by clicking on the link down below. We just added the new tactical watch list where we have some of the key assets that we're currently watching. You can click on them and see all the key technical structures or key comments that we have on each asset, what we're currently looking at. And of course, this is updated multiple times a week. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to click on the like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.